Good evening, everybody. My name is Daniel Young. I'm the owner and founder of Adaptive Perspective and the Adaptive Perspective social media platforms. And I am back to talk about our stock market investment strategy using closed-end funds, as well as some other stuff just in the news currently. So to get the normal disclaimers out of the way, this is an unedited video. Who knows what you'll hear in the background as I continue to film these in my house. I am not a financial advisor. I am a strategist and a financial strategist, and I don't speak like the herd. I walk in limited company and sometimes I walk alone. So my mission with these videos remains to be able to justify our financial decisions. Not that I need to justify them, but as I make our choices in the stock market, me being able to orally describe what we're doing, which is far different than speaking to yourself in your head. It helps me rationalize out my strategy, and I'm sharing that with you all. The other part, and it's not one and then two, or it's not number one and number two. It's synonymous. The goal is to help people realize that there's a better way to invest than the traditional shitty stock market investment strategies. Um, and I've got into this in great detail before, but this is not a 60-40 bonds to or stocks to bonds ratio. It's not a 4% rule. It's not any of that. There's a much better way to invest than the traditional buy and hope method, or and I use this example a ton, but it's not the buy now because Apple or Microsoft or pick your fund will be 10% more in 5 years, and that's 2% growth a year. Inflation is at 3 to 4% a year, and those funds don't pay anything in dividends. So you're losing money on outright devaluation. You're not keeping up with inflation, and they're paying you a paltry penance. Uh, no reward to own their fund. They're essentially asking you to buy on faith and hoping themselves that their fund is worth more and that you keep their fund. That's horrible advice, horrible strategy. Closed-end funds present us with a much better option for dividend growth. We retain our capital, we get rewards, we get really fat rewards, and that's sound advice, that's sound strategy. So my goal is to help people realize there's a better way, and in doing that, I'm one, communicating that to you, but two, I'm relying on you to help me spread the word. So please don't keep the information to yourself. Please share it. If you like the content, yes, share the videos, comment on the videos. I interact with people who comment on videos, like the videos, and then subscribe to my channel. And then, yes, share the good news, because there is a much better way than the foolish traditional stock market investment strategies. And that's my cat in the background. He's been a bit of an asshole lately. Don't really know why. Um, so as for the market and the normal deep dive, I deep dove everything last week, and I don't want to do it all again because it's a lot of info. It makes for a really long video, and to re-say the same thing every week just gets redundant. So if you want the full story and that full glass of iced tea, then look at last week's video. Not much has changed in the stock market except some tampering fear from the Middle East stuff. So, which my goal is not to get into directly on this video. And regardless of all of our feelings on that, the media pushes fear, which I'll reiterate as we go. But the newbie investors, the herd, those guys, gals, those guys seem to have a giant aerial, like a TV antenna that's extremely fear sensitive. Any negative win, any possibility, no matter how significant or scant, causes that antenna to go haywire in the market response, right? A couple of weeks ago, the market was in greed. Currently, it's neutral. Part of me thinks it's going to drop into fear again, right? And that short game impacts everything because we can have long-term strategy, but how we manage the existing market impacts our long-term outcomes. So regardless of what the market's doing, we're still looking for the best deals. And we're using that current market, whether it be greed or neutral or fear, to scoop deals that help our position the best going forward long term. So here's what we're currently targeting and why. And the why is a big factor. A lot of people, even the group I pay for, tell you what to buy, but they don't always tell you why. And that irks me. Like you can list out whatever you're going to buy, like whatever. Everybody's got an opinion, right? But why? Not just you should do this. Great. Okay. Wonderful. Why? And when there's not that connection, when there's not that explanation, that bothers me. Either they're unwilling to share their strategic plan or rationalization of why they're doing something. But if they can't articulate why they're doing it, doesn't help me buy into their methodology. So without a reason to buy, what's the point? So here's what I see as I read the current batch of tea leaves or the current dregs in the bottom of our tea leaf cup. The market is well placed for an anything's fair strategy. Like really whatever you want to target, you could justify. I still see a bull market on the horizon, but currently we're in the midst of a market that's still ripe for bonds, municipal bonds, real estate, energy transfer, utilities. So bonds and bonds proxies, right? But we've really reached a point where you can argue for stocks and you can argue for funds that sell calls on stocks. So in bonds, gosh, so many bond articles right now. Um, when the market went crazy on tariff day and then it dipped again, right? We have all this tumultuous wave-like action. Everybody freaks out. Or I won't say everybody. A lot of people freak out, the herd especially, and their teleprompter jockey herd handlers on the news. They push that fear. God, they push that fear mantra. So any little blip we have, tariffs, debt, debt ceiling, you pick it. All of those individual markets respond, and it's been this way to me in general since tariff day. But out, outside of our nexus of advisors, the sentiment seems to those people that the bond market as a whole is finally stabilizing. Now, they're late to the party because it's been stable for a while, but that still points me in the direction of it's a great bond market. Now, the Fed kept rates the same in June, which goes to everything I've been saying from the beginning. Fat lot of help they are. Um, I mean, they should have dropped rates about 3 months ago, but they won't. So if or when rates fall, bond prices will rise, right? We've actually already seen some of our favorite funds start that ascension, but they're going to rock it up with lower rates. And what I'm hoping, I mean, I would like special dividends at the end of the year. Everybody's planning for the current rate, for the current cycle. Rates, uh, short-term interest rates get cut, bond prices go up. Really, everything should go up. Companies will hopefully have more at the end of the year, and we'll get fatter dividends at the end of the year. But we'll see. On the stocks end of things, I got into covered calls last week, and I mean you're gonna see I have a lot more windows open than normal. But I'll share my screen. You can read what AI says about covered calls this week. Um, Lots of God, there's so much stuff on covered calls. Um, and my normal go-to is Grok for information. I like the platform better, but Google works but easiest because everything else I'm on is Google right now. Um, I'm not going to read this to you. Pause the video and read it. So, in the meantime, covered calls are decent. or good, however you want to say, good consideration because while I'm hopeful for that coming bull market, all of those newbie investors don't have the same level of hope. They're optimistic, which is better than them echoing the Fed's needless pessimism, but they're too worried about the Fed's refusal to drop rates. And they don't get that it's a power game. So while I'm hopeful and really expectant of a bull market, using that newbie investor optimism, using the herd's optimism that a better market is coming, plays well into covered calls. And if the market just breaks out, maybe we, like if we bought one of those, maybe, or a couple of those, whatever you buy, if we bought one, I mean, we would keep it. We could ride the market, see how it goes, right? Or we could quickly sell it and move the money into something else. Outside of covered calls, outright tech is overpriced. And the normal tech giants, Nvidia, Amazon, Alphabet, Microsoft, Apple, Taiwan Semi, ASML, IBM, like pick your tech giant. It makes me hesitant to buy the blue chip fund I've been, I don't want to say coveting because that's not the right stance, um, or the right word. I've been tracking for a while. Like it's been on my hit list for a while. Uh, that ADX fund, that Adams Diversified Fund. But that said, like it's loaded with tech, but at the same time, they're also playing the current market. Funds can easily switch strategies, just like you and me. We have, I mean, my portfolio compared to what ADX has in theirs, right? Is mine is far smaller. They're managing a lot more money. Both of us can still completely change tracks and invest in other stuff. So they're invested where the market is right now. And that being said, I mean, the AI and the tech bull market are still going on, and they're going to be going on a while. Like I read a recent article that said, I want to say, so it was Meta in particular, and I think the data was relating to Meta as well. Meta essentially has a hiring freeze where they're keeping all their current employees. They're not firing anybody, but they're also not hiring any new employees. They're pushing all their money into AI, and it's saving them money and overhead. So we're finally in that gray area stance where not robots are taking people's jobs, but AI is taking people's jobs. So Meta, by creating a hiring freeze, Meta is now raking in 1 to 2 million per employee in profit. And it's only going to go up because how much AI is going to start getting integrated into everything. So you still need people, you just don't need as much people. And that'll be an interesting problem as society evolves. Uh, and I think I'll save the rest of my ADX stuff for uh, the actual breakdown, which will save quite a bit of time, I believe. Um, so outside of tech, the other parts of the market are better priced. The problem is almost every company is tech based now. You can rank Mondelez, which makes Oreo, among other things, but you can categorize Mondelez as a consumer product because they make Oreo and whatever else they make. But it's a tech company because of how much technology goes into producing that highly addictive food additive delicious cookie. So outside of tech, so I would say like outside of outright tech, like tech giant, that list I already gave, the other parts of the market are better valued. So it's like it's almost like I'm willing to consider stock funds who sell covered calls, but I'm not a huge consumer fan because that market space is so tumultuous. So it really comes down to how you strategize it out. You can use the current market in the short term. You can look at the market overall in the short term and play it for the long term. You can buy covered calls, sell those when the market turns. You can buy uh, ADX for the long run. Yeah, but we'll get into this more when we get into the list. So uh, let's see. Yeah, that pretty much by cutting my ADX deal out of it and saving part of it for the list itself takes out a lot of content. So let's look at the list for the week, and you're going to see a lot more tabs at the top, but that's okay. We'll get into that. So this is not the week where I update everything. I updated the color coded list for the week, which would be, I mean, this is not the master list. I mean, there's only 27 funds here, but I went through everything green and purple. I went through the stuff we owned. I updated current share cost, current NAV. I double checked the target values or the target asterisks. And then I transferred the list of the dollar cost average funds, the funds with two asterisks, and everything that has a significant discount, meaning the current discount is greater than the 5 year discount, or and it's double than the historical discount. Or if it's a newer company, those boundaries or those restrictions are a little more lax, and it plays into the funds that are exceptions to the rule. But this is the list we end up with. I am working on a I'm working on a way to find, I guess that's redundant. I'm working on figuring out the best overall site to host content. I used to run a blog. It takes so much work to run a blog, so much work to run a blog. It takes 3 years to be not even trending, but it takes 3 years to really appear on Google. It takes at least 3 years to be profitable. Um, quite honestly, I would be paying somebody else at this point to maintain the blog because it's just so much work. So I got rid of that. I moved the I won't I don't want to say general, but I moved the systemic financial strategy to Facebook. It started there, started a group there with adaptive perspective called Navigate Your Finances. But I'm currently finishing a book where the closed-end fund system, I mean, end to end, is included inside that book in one of the chapters. But I'm looking for a place to host content. Um, and I still think I'm leaning toward Facebook, but it's going to be a different integration than how I'm currently set up. Financially, the book is a 12-step system to financial freedom. It's so all housed within adaptive perspective. So there's the ebook, 12 Steps to Financial Freedom. There's like the day-to-day navigate your finances. There's this targeted strategy with closed-end funds. I run a scholarship page, which is completely open access, no membership, no email, no payment, no fee, no anything, just free information on thousands of scholarships. I think I'm at like 1,100 scholarships. So maybe not thousands, but hundreds of scholarships. Um, and I need a system that will house data and not just video content. So TikTok isn't really a great choice. Um, Instagram and I don't get along well. OnlyFans is attempting to dispel their stigma and stereotype, but they're not doing a very good job of it because I mean, OnlyFans is attempting to promote anything that's not pornography, but when you go to the OnlyFans homepage before you sign in, all you see is um, actresses on that introductory page. So they're not exactly fixing the stigma. Um, and if I'm looking at a place to really integrate and put everything together, to where not that it has to be necessarily housed on the same exact page where I'm talking about everything on the same exact page, but it makes it easier to house it on the same platform to have, like financial freedom under that, this, under that, closed-end funds, after that, scholarships, etc. It's really hard for me to ask kids and parents to go to OnlyFans and know they're going to see that intro message on OnlyFans, regardless of what my content shows. Um, LinkedIn is great, but it doesn't have tiers. And quite honestly, uh, there's not really a great membership capability. So that's really, I mean, that's Facebook. I just got to figure out the best way to do it on Facebook. So, all of that said, I'm looking for a place to house this. Several people have asked for access to where you get the full downloadable spreadsheet, and I'm happy to offer it. At the same time, it's finding a place to actually house that data. Um, and then, besides the spreadsheet, uh, at least one of you has asked for information on creating a spreadsheet. Um, and then I would show you how to get. So, I mean, this is the spreadsheet that tracks everything, but at the same time, it's linked to this spreadsheet that tracks dividends. So I project dividends every month. I mean, this will give you an overall projection of each individual dividend based upon when we buy it and what the supposed payout is supposed to be. Uh, Compared to like FCO just raised their dividend, right? So it scales that dividend, I believe. Um, Excuse me. But then the actual dividend tracker, all of this data relates to, I love when the spreadsheet just changes. These are years and not dollar signs. There we go. Um, it's the weirdest stuff. Google will just randomly change data in spreadsheets. Um, but yeah, but all of this data, especially this like running total, so I can track dividends over time. But the running total of things ties into this, and it's broken down by stock and then also by individual purchase date. So I can show you how to do that on a video. And it looks complicated if you've never done it. Um, this is not the first edition of this spreadsheet. I mean, yes, it's new because it's the new Fidelity Fund. Um, but that's not my point. It's when I first made a tracker for funds and dividends, it did not look like this. This is at least the third different version, and I'll update it every year. Um, so if I find something this year that I wanted next year's, I can add it this year, but then I'll really implement it and change it the next year. But at any rate, I mean, I can show you how to create this spreadsheet. It's challenging because it will be if you're unfamiliar with spreadsheets or sheets like Google Sheets, it's challenging the first time, like everything is, like the first workout, like the first budget, like the first anything. It's challenging and it's difficult, but the more you do it, that you get the hang of it. Plus, it's not like I would just give you the numbers. Like we would work on formulas. Some of these are easy formulas, some of these are not easy formulas, but I teach you how to do it. And that way you can make your own portfolio tracker. Uh, all right, so let's get into the week though. So I'll keep working on my end on best hosting, and whenever I figure that out, I'll let you know. But for the week, we have this. So the goal is we're pretty much going to hit ADX right off the bat, but the goal is monthly payers. So we can take that off. ADX, I went back and forth for at least an hour today on can I can I logically and rationally buy ADX and prioritize it above anything else? And I have a hard time doing that for several reasons. One is the price. It's generally it's above my general comfort level. I try to keep everything 15 and below. The the gray out area on the master spreadsheet is set at 16, but I really try to keep everything 15 and below. Now, if the entire stock market gained in value and everything went up by $3, then I probably have to change my strategy. But we're not there. So the price, I mean, and I like sets of 50. And right off the bat, I would probably buy 100 shares. That's 2 grand. So can I really justify 2 grand over something else? I dislike its payment, or I dislike its dividend cycle. It's an alternative category two. So it should pay 258.11, but now this one pays 258.12. It should pay the second month of a quarter. So one, two, three, four, five, six, right? So it pays an off cycle quarterly payment. I dislike that. I dislike the randomness of the dividend. Now, this is the dividends we've seen so far, but we haven't seen an end of year dividend yet. They used to pay 5 cents a quarter, and then they paid this giant fat hidden dividend at the end of the year. That changed. Their dividend policy changed. Uh, Michael Foster reported that ADX is committed to dispensing 8% or at least 8% of their current net asset value as a dividend throughout the year. So if you take it as an overall, it works out to about 45 cents a quarter. So we don't really know the actual dividend for the year because we don't know if they'll have extra money by the end of the year. We don't know. So maybe they'll still end up with some type of dividend. But it's also a dividend that changes a little bit. It and I listed it at 45 because it's not the average, but it's close to the average of these three things. From my vantage point, and I get that it's my vantage point and not the company's vantage point. My vantage point would be, look, if you're just going to create an average, right? Like if it's about 45 cents a month, why not just divide that equally and just pay everybody 15 cents a month? Now you're a consistent monthly payer. And then if you have money at the end of the year, if you have extra money that you can dish out in dividends at the end of the year, that looks even better for you. So my suggestion, if this in any way gets to somebody at ADX making decisions, become a monthly payer. You leave your stock price the same. It is what it is. It's based on a lot of different things. Your portfolio is great. I mean, I would love to buy your fund, but in whether in retirement or if you're using your dividends to cover monthly stuff, it's really hard for me to justify picking up a quarterly fund, knowing that I'm only going to get paid quarterly. And one of those payments is going to happen on an off month. But if you became a monthly payer, now I'm getting consistent monthly payments. And which I am not a retiree, but as a retiree, consistent money matters. And consistent monthly money matters, regardless of who you are. So if you became a monthly payer, a monthly fund, That would be huge. Your price point is above my comfort level, but as a monthly payer, that's a much harder argument or a much stronger argument for me to combat because it on my end of things, I'm looking at buy-in price. I'm looking at monthly payment. I'm looking at consistent dividends. I like the discount. I mean, I would like the discount better if it was closer to 10. 2.3 isn't far from the average discount. You can make a good case for it, but it's not quite there. Um, but if you were paying 15 cents a month consistently and you added a special dividend at the end of the year, that's a pretty good case. And it's the track record of the company. If you, I mean, I don't have the scale chart here, but if you look at what's in their fund, they're playing the current market. It's predominantly tech-based funds. It's weighted heavier than I would. I mean, I like 2% or less by fund, but when you're targeting tech-based stuff, you're gonna over and maybe not overinvest, but you're gonna get overweighted in specific funds. But it's a great portfolio, but it pays quarterly and off quarterly, but the price and but the dividend. And if you change this, it drops the dividend under 9%. But we don't know what it's going to be at the end of the year. So as much as I like the company, I don't know. And I get the long-term measure. Like the last, I mean, gosh, you can go back 20 years and the company's performed awesomely. You can go back 5 years and the company's done fantastic. And the bulk of the growth has been paid in cash dividends. That's fantastic. I just don't know if I can convince myself to buy it. I mean, price wise, and it's the ability to buy it long term. So the initial 100 would cost, right, a little over 2 grand. But then to pick it up again the next time and then pick it up again the next time with the quarterly dividend, with the unknown end of year, and with the off month, it's really hard to pick that up knowing I can get a monthly payer that pays pretty darn well. Now it won't pay. I mean, the I would look at NBXG that I think will eventually raise their dividend. You're looking at ETB as a covered call, but it's predominantly tech-based ETB. ETW didn't make the list this week based on discount. They sell covered calls on the same tech funds. Um, but nothing pays 15 cents a month. So if for whatever reason this reaches 80x, my suggestion, which I get it, y'all are incredibly capable, intelligent, smart, amazing people. You run an amazing fund, but take it from the take it from whatever you want. Just the advice of a random guy on YouTube. Go monthly. Change your dividend to 15 cents a share. Pay a special dividend at the end of the year, and see how your fund changes. So if we look at cover, and we'll leave this here for now. Actually, we'll just take it off the board. So if we look at the ETVs or the ETs, there's ETB, ETV, ETW didn't make it. They pay a great dividend, but it doesn't meet the discount metric. So you can pause the screen. It's so pause, slightly different look, very similar portfolio, but more holdings in different weights. But where ETV or the ET sets get interesting is when you come and look at their overall distributions. The ETB isn't that far off from where they were. They paid a fairly, well, I wouldn't say fairly, they paid a consistent dividend forever. And we have the rate issue, and now they're raising their dividend back. ETV, similar, right? Not quite what it used to be, but close. ETW, you could make a case for it, but it's this previous track record where the other ones were consistent all the way through. This one had the lowering dividend and now it's coming back, but I don't know where it's going to come back to. So I think ETW for sure stays off the list. In the short run, the ET set, ETB, ETV are decent options for right now. Uh, but outside of ADX, if I'm looking for a blue chip fund that pays monthly, NBXG presents a great option. It's still heavy weighted in certain funds, but interestingly enough, Apple doesn't sit in their top 25. Microsoft is here. Microsoft's currently the world's largest company. It surpassed Apple and Nvidia, and has stayed above Apple and Nvidia the last couple of weeks. But I like it because it's invested in other stuff besides outright tech. Chewy, Netflix, stuff you and I don't have access to. So NBXG is targeted at 5G tech and anything that would benefit from 5G tech, which you would think would be Apple, but for whatever reason, it doesn't make their top 25. Now, maybe it's buried in the list, but from the last semi-annual report I got from NBXG, because we already own it, I don't remember Apple being in the list, which is just, it's interesting. Uh, on my end of things, I'm not a huge fan of J&J, so I would drop ETB and stay with ETV and stay with NBXG. So if we come back and we sort the list, knowing all of that, so bonds, loans, BDCs, and bond proxies. So you get utilities, energy transfer, real estate, and tech. So real estate stays. You can keep this on your list all you want. I've been outspoken against HGLB going from targeted investments by category into a more portfolio and account approach, which I get that's relative because as everything gets moved into a tech company, or really anything can be assessed from a tech perspective, Morningstar, CEF Connect, anybody else is going to categorize companies' funds based on where they best fit in where they think they best fit in the market, defensive, and um, see consumer, tech, infrastructure, the list goes on. So whereas HGOB might not consider their fund a portfolio in a can invested in everything, that's how it's ranked, or that's how it's listed out online. Um, NBXG, yes, all stocks, all 5G stock, same thing. Feel free to pause the video and read all of this for yourself. This is an older missive from Brett Owens in Contrarian Outlook, um, or Michael Foster in Contrarian Outlook. I forget who wrote it, but it's about a year old, but it's still very poignant for today. Calamose funds have had, I want to say they've had dividend issues. Um, but here, instead of doing it this way, so we'll go back to the traditional. Everything has a significant discount except for, and really even for the dollar cost average moves, the municipal bonds. Everything is a monthly payer. If we rank it by yield, we it's the goal is 9% or above yield, unless there's a good reason for keeping a cheaper yield, which would be these three municipal bonds, because they all pay like it's a tax equivalent yield or a tax equivalent dividend. So the actual yield is about 2 to 2.5% higher than the posted yield. Uh, I have history with Allspring. I'm not a huge fan. Doesn't meet the 9%. Calamos Realty is a great portfolio. It's just high and like we own a Cohen and Steers fund that didn't make the list. But if you're looking for a different way to do real estate, I would check out that fund. NBXG doesn't make the list, but we already own it. It's not that much higher than what we own. I get it's not quite 9%, but I think they're going to have to raise their dividend soon. Calamos, HFRO, it's the most significant discount, which has come down. Like it used to be a 60% discount. 4% may not seem like a lot, but it's a lot. So it's close to a 9% dividend. And at 520, it's just there's so much value in their portfolio. It like it looks like there's so much light at the end of their tunnel, and it's not just a train coming your way. If, gosh, a rate cut would help everybody, but I think a rate cut would help them a lot. Um, and the ETs. So ETB does fit that it's a 9% dividend, but I'm not a huge fan of J&J, so I would go with ETV. CIF, I've talked about. It's the on the small on the pendulum swing. There's FCO and there's CIF. Uh, CIF is the roller coaster play in the sense that if you look back at its history, its price history has done this versus FCO has just done that. Um, let's see. Megi is a great pickup when it's close to the 1 year discount. So it goes back into how much you want to argue that 7.6 is close to 10%. For me, it's not close. FCO, the discount has closed considerably, considerably, but it's still a good buy. I mean, I think we'll eventually see it go premium. Oh, so it stays. EIC. So the CLO market saw a pretty significant sell off this last week for reasons that I don't honestly understand. Um, and there's a lot of stories about it. Um, so I don't share their fear. Um, that being, it's that weird part of I don't share their fear, and quite honestly, fear is a great time to buy. So on my end of things, I would play it as buying what we already have. EIC is a great company. Earn is pretty new, but the more I look at Earn is advertised as a CLO specialized company. They should have a lot of individualized CLO allocation. But the more I dig, the less allocation I see. Like some of our bond funds have a higher um, securitized debt allocation than Earn does. Earn's a former mortgage focused company that changed into a CLO focused company, but their current data doesn't show that. Now, that being said, the current data is extremely limited. CF Connect has nothing on it. Morningstar has very little, and it's hard to find anything on the Ellington website. So, I mean, their pricing seems to be trending up. But that being said, we already own OXLC, and I've said it on past videos. Anytime OXLC is in a discount territory is a great time to buy because they don't go in discount that often. So I would stick with what we already have. Now, this leaves the rest of the field. So, River, I love finding my mistakes. If you ever find a mistake, tag it on a video and I'll fix it. Um, in order to pick up a bond fund, it's got to be better than what we currently have. And we're pretty diversified. Troublesome, tricky word on my end of things, I know, but we're pretty diversified on the bond front. So picking up some like I just to throw out an example, if a PIMCO fund came up in significant discount and the price was right, I would buy it for its brand value as a PIMCO fund. But I don't know if it would have anything different than what we currently have. So to buy a PIMCO fund would still have to be justifiable. If it's a great deal, a great discount, they have a great dividend, and it's a PIMCO fund. So it's not, I mean, it's not like 100% it's going to go to premium. But if you look at the PIMCO track record, they're pretty much all in premium. So maybe that would be worth it. But it would still, I would still have to be able to justify it. Point in case. Um, and I'll stick with this. Yes, it has a discount. Yes, it pays a greater than 9% yield. Yes, it's under 16, but I really don't like buying funds that are $15 or above. I've bought them before, DSL being a prime example. I've bought them before, but it's not my favorite thing to do. Excuse me. So what does that leave me with? OXLC, BRW, and FCO, which are my two favorite bond funds outside of these municipal bond funds. ETV for covered calls on tech, which same thing. If you look at the breakdown, which I mean, you can go back and look at their top 25 on breakdown. They're broken down into all these different subcategories, but they're all tech funds. So they're selling covered calls on tech. And in an optimistic environment, that's a decent strategy. Now, if it's a straight bull market, bull in the China shop, everything is escalating, it might not be the best strategy. Real estate, outright technology. So this is the counter argument. So you can play the short term game. We're in a neutral to optimistic environment, covered calls, selling at hopeful values, but not escalating value. So covered calls plays the short term market well, but it's not a long term strategy. Or for a similar price, slightly different, but for similar price, you can buy a fund for long term growth who pays a consistent dividend that from my standpoint, it's my hopeful standpoint, but it's a dividend that will go up versus we have an uncertain dividend that we hope will go back up. It's close to what it was originally or what it's been consistently, but it's not there yet. So you can play the short game, you can play the long game, or pending your funds, you can play both. You can buy this one, let it run its course, sell it, push the money forward, and then see what is the best deal in the market at the time. Now, this week should be our buying week, but it's not going to happen. It's not a money thing. I'm not going to talk about the Iran situation in regards to politics. I am going to talk about it in regards to the market. Regardless of your stance, regardless of my stance, where do you think those newbie investors are headed? Right? I see the media, I see the market pushing fear. and uncertainty. So I think we'll move further into fear territory. Now, maybe we won't, but that's kind of where we're headed, regardless of what happens. And I'm not going to get into the political stuff at all. The media sells fear. Iran, Israel, US is a huge unknown. The herd hates fear. So, as much as I'm tempted to buy this week, I'm for sure hesitant to buy this week. And it's that like, I don't want to buy Monday. I really just want to see how much fear gets pumped into the herd and how much fear tries to get pumped into, or how much they try to pump fear into the rest of culture. Um, so, me personally, I'm going to wait because honestly, if the herd senses fear or the herd sniffs fear, the market's going to dip. And I would much rather buy the dip than buy where it is now. Because if you valued all of these funds at like 10, not 10%, but say like you valued all these funds at 20 cents less, that's not a huge deal. But 20 cents per fund over time adds up. So it should be our week to buy. Maybe we'll buy Friday. We'll see how the week goes. Maybe we won't. But I'm going to wait Monday and see how much fear seeps into society at large, and whatever that amount is, more of that, like it'll be a greater dose going into the herd because none of those jokers want to lose money. None of them are ready for a storm. None of them have the right mentality. All of them are out for quick money, and they don't have a long-term game plan. So yeah, so I want to see what the herd does, and then I'll go from there. But I mean, that's my list for the week. That's where I would go. If you had me trim it down further, it depends on how you play the stock strategy. I mean, so if you're not into if you're not into municipal bonds, you take the last three off the list. OXLC, it's a hard pass. I mean, OXLC on discount is hard to pass on. But if the market goes south, OXLC will go further south and it'll be a better buy. Um, bonds, I love these bond funds. Real estate, I do. I like this fund. Um, but for the long-term strategy, it's tempting to play the short-term game because I am hopeful for the bull market. And the herd, for the most part, is hopeful. I don't know how they're going to respond to the Iran stuff or the Iran stuff. From a course I took in college, it's actually Iran, like two E's, Rawn, Iran. Um, I don't know how the herd will react to that investment conundrum. Um, but if you're unwilling to play the short game, I would play the long game. But that's just me. So that's all I have for the week. Um, let's see. Advice for the week. Do not get sucked into the fear and anxiety. Don't be afraid to turn your phone off or put it on the side or just not watch the news. A lot is going to be said, and there's a lot of misdirection going on. You got to remember the purpose of the media is to sell itself. If you look at your local news, and I don't watch a lot of local news, but if you look at your local news and look at how many good stories happen and how much bad, fearful, horrendous, like evil people stories happen, the news is designed to push fear upon you. My advice is to not let it get to you across the board. Focus on the stuff that you can change. Focus on the stuff that you can do. Focus on the stuff where you can make your life better. But don't buy into the fear and panic across the board. So, whatever you have for the week, I hope it goes well. Whatever you're doing investment wise, I hope that goes well too. And if you want to talk stocks or closed-end funds or overall investment advice, or you've got suggestions about a hosting platform, then by all means comment on a video. And then, yes, if you like my content, then please like the video, subscribe to my channel, and then share it out to your friends in your group, because the more people that realize that there's a much better way to invest, the better. Better for them, right? Better help, more help for them, more encouragement for them. Because as much as I want to grow my channel, I really just want to help people, right? So help me help others and share the video and the content with them. So whatever you have for the week, I hope it goes well. And I will see y'all on another video. Bye bye.